Cost classification is a fundamental principle of management accounting that involves grouping costs according to their nature, function, behavior, or relationship with cost objects. Proper cost classification enables managers to prepare budgets, value inventories, control expenditure, determine product profitability, establish selling prices, and support strategic decision-making. Since different managerial decisions require different cost information, understanding cost classifications is essential for effective planning, performance measurement, and operational control. The program emphasizes cost classification as the foundation for costing systems and management information. One of the most important classifications distinguishes between production costs and non-production costs. Production costs are those incurred directly in manufacturing goods or providing services, and are therefore attributable to bringing products into their present condition and location. These costs include direct materials, direct labor, direct expenses, and production overheads. They form part of the cost of inventory and ultimately become cost of sales when goods are sold. In contrast, non-production costs relate to activities outside the manufacturing process and include administration, selling, distribution, and finance functions. These costs are treated as period expenses and are charged directly against profit in the accounting period in which they are incurred rather than being included in inventory valuation. Non-production costs may be divided into four principal categories. Administrative costs arise from managing and supporting the organization, including accounting department salaries, office rent, and general management expenses. Selling costs include advertising, marketing campaigns, sales commissions, and promotional activities designed to generate customer orders. Distribution costs are incurred in delivering finished goods to customers and include warehouse operation, transportation, and delivery expenses. Finance costs represent the cost of obtaining capital, including loan interest, bank charges, and financing fees. Although essential to business operations, these costs do not contribute directly to product manufacture and therefore are excluded from inventory valuation under accounting standards. Production costs consist of three major elements: materials, labor, and overheads. Materials represent the physical inputs consumed during production, such as raw materials, components, packaging, and consumable supplies. Labor costs comprise wages and salaries paid to employees directly involved in manufacturing, as well as indirect production personnel. Production overheads include all manufacturing costs other than direct materials and direct labor, such as factory rent, depreciation of machinery, maintenance, utilities, supervision, and indirect materials. Together, these components determine the total manufacturing cost of products and provide the basis for inventory valuation and cost control systems. The distinction between production and non-production costs is particularly important when valuing output and inventories. According to accounting principles, only production costs are capitalized into inventory because they are directly attributable to manufacturing products. These costs remain as assets until the goods are sold, at which point they become cost of sales. Non-production costs are recognized immediately as operating expenses in the statement of profit or loss. Incorrect classification may overstate or understate inventory values, distort reported profits, and produce misleading financial statements and management reports. Accurate classification, therefore, ensures compliance with accounting standards while supporting reliable performance evaluation and decision-making. Management accountants also classify costs by function, distinguishing between production, administration, selling, distribution, and finance activities according to organizational responsibility and operational purpose. Functional classification supports departmental budgeting, cost allocation, and responsibility accounting by assigning costs to the functions that generate them. This approach facilitates managerial control and highlights opportunities for operational efficiency improvements. Another important classification distinguishes direct costs from indirect costs. Direct costs can be specifically identified with a particular cost unit or cost center and include direct materials, direct labor, and direct expenses. For example, cloth used in manufacturing shirts or wages paid to assembly workers are direct costs because they can be traced directly to individual products. Indirect costs, commonly called overheads, cannot be directly attributed to a specific cost unit and include factory rent, supervisor salaries, equipment depreciation, and maintenance expenses. These costs must be allocated or apportioned across products using suitable costing methods. Cost behavior provides another important basis for classification. Fixed costs remain constant in total regardless of activity levels within a relevant range, such as factory rent or insurance premiums. Variable costs change directly with production volume, including raw materials and piece rate labor costs. Semi-variable mixed costs contain both fixed and variable elements, such as telephone charges comprising a standing rental plus usage charges. Stepped fixed costs remain fixed over a range of activity, but increase in discrete increments once capacity thresholds are exceeded. For example, requiring an additional production supervisor when output surpasses a specified level. Understanding these behavioral classifications enables managers to forecast costs accurately, perform cost-volume profit analysis, prepare flexible budgets, and make informed short-term and long-term business decisions.